everyone, and welcome to part 2 of this week's seminar on racism and economic systems in the United States. In this presentation, we will go deeper in some of the ways the wealth gap between Black and white families is created and sustained, with particular emphasis on factors affecting home ownership and how wealth accumulation can be difficult to achieve for families in historically excluded groups. So mainly we will focus on two specific areas related to wealth accumulation. The first one is the impact of home ownership, and the second one is looking at the reasons or some of the ways wealth accumulation can be delayed for many families. Let's start with the home ownership. And as I told you before, home ownership is the main factor in climbing the wealth accumulation ladder and the gateway to building intergenerational wealth. However, the ability to purchase a home is unequal between families based on race. According to MarketWatch, Black families in the United States have an ownership rate of about 47% compared to 76% of white families. And there has never been a time in America's history where a majority of Black Americans were homeowners. Additionally, in a recent study by the National Community Reinvestment Coalition found that in 2020, the gap between Black and white families owning homes grew to be wider than at any time in the 20th century. This lag in homeownership is complex, but it is strongly related to the financial stability of a family and government-designed housing policies. Black families experience high rates of financial instability due to institutional racism and systemic mechanisms that have existed for centuries. These conditions go beyond individual effort and reflect an economic system that emerged during the Great Depression that overall disadvantaged Black families and neighborhoods overall. Let's look at closer at the housing policies created as a result of the Great Depression and how these policies, known today as redlining, have contributed to the lower rates of home ownership among Black Americans. So according to the Investopedia, redlining is the discriminatory practice of denying services, typically financial services, to residents of certain areas based on their race and ethnicity. Redlining emerged in the 1930s as the federal government began marking risky neighborhoods for federal mortgage loans based on the expected default rate. The definition of risky was explicitly tied to race without basis in fact. For example, the safest neighborhoods were marked as green with no Black families, while red meant more Black families and an assumed higher risk of default. Let's go back to Great Depression era to understand what exactly happened. So before the Great Depression, homeownership was expensive due to stringent requirements in mortgage terms. For instance, you couldn't buy a house without making a 50% down payment, and mortgage terms were limited to repayment terms of 10 years or less. During the Great Depression, many homeowners couldn't make their payments. Large portions of the population faced foreclosure, which could have made overall economy even worse. So to avoid further economic collapse, the government wanted to rescue existing homeowners from default as part of legislation known as the New Deal. So the New Deal featured two main policies related to homeownership: the Homeowners Loan Corporation, or HOLC, and the Federal Housing Administration, or FHA. So created in 1933, the HOLC was created to protect current homeowners from defaulting on their loans by offering to refinance their mortgages with flexible repayment plans. Offering these terms meant more risk to the banks and overall economy. Therefore, the HOLC wanted to create loans which had a low risk of default by assessing borrowers' abilities to make payments. The decision was made to tie lending decision and risk to the racial composition of the neighborhood. The HOLC created color-coded maps with the safest neighborhoods colored green and the riskiest colored in red, even if the financial means of these Black families didn't indicate such a risk. The racial composition of the neighborhood became the deciding factor, which had the effect of codifying housing segregation in the United States. The New Deal also targeted first-time homeowners in low and middle-income brackets with the creation of the Federal Housing Administration, or FHA. The FHA introduced more flexibility to the mortgage industry by creating less stringent mortgage requirements, such as 25-year payment plans and fixed interest rates with amortization. However, these favorable mortgage terms were only available to middle and low income white families due to lending guidelines set out in the FHA underwriting manual, and I'm quoting here, incompatible racial groups should not be permitted to live in the same communities. And I'm closing the quote. These guidelines meant that Black families were excluded from buying homes in developing suburban white communities because even one or two Black families would reduce the property value of the entire neighborhood. And the FHA wouldn't even issue mortgages in these neighborhoods. As a result, many banks and real estate developers wouldn't sell these homes to Black families. And even when Black families purchased a house in a redlined neighborhood, the FHA would refuse to insure their mortgages. FHA policies therefore furthered the segregation created by the HOLC and made racial segregation an official requirement of the Federal Mortgage Insurance Program. Until 1968, when the Fair Housing Act banned racial discrimination in the housing market, 98% of all FHA insured loans went to only white families. 98% of all FHA insured loans, again, I'm repeating, went to only white families. So basically, federal housing policy harmed the ability of Black families to own a home and segregated them in neighborhoods with lower property values. These policies also affected the rate of property appreciation in Black neighborhoods by artificially limiting demand. Taken together, these conditions had significant negative impact on the ability of Black families to build the intergenerational wealth currently enjoyed by white families who were favored by policies and didn't face redlining. In addition to individual households, these policies also hurt communities. The redlining and the federal lending policies, which devaluated property in Black neighborhoods also led to a decrease in tax revenues and a loss of more affluent households that moved to other neighborhoods. So basically, that practice lowered the tax revenues, and lower tax revenues have had a negative impact on schools in red line neighborhoods due to a lack of funding. And underfunded schools mean fewer educational resources, which hurts the ability of Black Americans to attain the education and skills they need to participate in industries with high-paying jobs such as technology sector. Although redlining is no longer part of the official housing policy of the United States here, redlining has had a profound impact on communities and neighborhoods in the United States that continue to this day. Here are some of the ways the effects of redlining and discriminatory housing policies persist today. First, redlining has made segregation chronic and shaped the racial composition of neighborhoods. Formerly redlined neighborhoods are still largely populated by minority groups. And the second thing is research shows that Black families still face barriers to obtaining a home loan. Black borrowers were sold more subprime loans during the Great Recession. Even today, studies show that Black families are less likely to compare mortgage terms and are disproportionately steered into more expensive loans than white borrowers. And also, racial bias still exists in the home appraisal processes as well. And there's evidence that home appraisals come back lower if the appraiser can't determine that the home is owned by a Black family. And next, redlining and discriminatory practices isolated minority communities and reduced housing and employment opportunities, which led to concentrated poverty and higher violent crime rates. Being born into a segregated neighborhood decreases an individual's earning potential, which also has a significant impact on their ability to accumulate wealth. According to Harvard economist Raj Chetty, individuals born into segregated neighborhoods tend to earn less, as much as $15,000 less than their counterparts. And also, studies repeatedly show that the main cause for the growing wealth gap between white and Black families that has been discussed in this presentation is due to systematic racism adopted in the housing market during the 1930s. So the second focus of this presentation is on the barriers to wealth accumulation that can be impossible to overcome at the individual level. The conventional wisdom of earn more, save more is less likely to apply when an individual is a member of an historically excluded group in the United States. Specifically, what I mean is Black Americans are paid less, even with the same educational level as their white counterparts. Also, studies show that Black students leave college with more student loan debt, which reduces their income long term. I also mentioned that Black families are less likely to receive an inheritance, which can prevent them from participating in wealth building activities, such as buying a house or investing in the stock market. Inheritance is a significant factor in wealth accumulation because inherited wealth is more shielded from taxation than income. Also, income earning individuals in Black families with less wealth accumulation may provide financial help to other family members. So they are also carrying the burden of other family members. Considering that they also pay income tax on their earnings, Black families are financially disadvantaged compared to their white counterparts, who are more likely to receive inherited wealth. All these factors contribute to delays in wealth accumulation for Black families and prevent them from taking advantage of the power of compounding. One of the most important wealth building strategy is to start investing early so that time can do its own magic and it starts compounding and build interest on your money. If an individual's income is entirely spent on survival and they have no chance of inherited money, investing early is impossible. This means that individuals miss out on the years when invested money earn compounded interest. The difference in time when an individual begins investing has profound impacts on their overall wealth. As you can see from the slide, a 10 to 20-year delay in investing can result in missing out on millions of dollars. So really, compounding is a very important component of your wealth journey, and starting early is key here that Black families are missing out. So this presentation has explored the wealth gap between Black and white families in America. We looked at the specifics of this gap and how systemic racism has contributed to significant disparities in the opportunities for wealth accumulation between Black and white Americans, including the federal policy of redlining neighborhoods that harm Black neighborhoods across the multiple dimensions. These challenges are widespread and significant and are generally beyond the ability of any one individual to overcome. So I also provided the references for the research used in this presentation, and I invite you to ask questions you may have about this topic covered here. And thank you for your interest and participation, and I hope to see you in our meeting next time.